Hi, this is Kim Watson. In this video, I want to introduce you to Elliott Waves and how you may use them. So it's a bit of an introduction to Elliott Waves. It does not have the deep and um, more advanced methods of using them and what you might do with them as you progress, but it will give you a good introduction. And for some people, even if you've covered Elliott Waves before, you'll find it potentially useful in terms of the extra little things that I found out in the time I've been trading. Now, this gives you a little bit of background. It was Ralph Elliott that identified that the markets move in waves, and he noticed these impulse waves, which were in turn 5 waves, and a corrective wave, which was a 3-wave pattern. So he's discovered these patterns. Now they're quite natural in many things that we look at. You could look at the sea and you'll see different waves, and you'll see surfers picking out those great waves. There's no real difference in a sense in terms of the markets working these harmonic waves, if you like. Now, of course, when I'm talking about this, there's a large chunk of theory on how it works. Reality of actually using it can be quite different, and it can take some time to get used to identifying the waves. So you do have to do a bit of homework if you really want to use it. Now, the market is not efficient. It's controlled by the whims of the masses, and it's manipulated by many of the big players. So it's not an easy market always to identify waves within or what's actually happening. The masses will often overreact, driving prices too high or too low. This is where we get these overbought or oversold conditions. Now that may also be driven to a degree by the big players who want to dump, sell into strength, get rid of their positions, or in fact buy lower so that they can themselves drive the prices. Now, we should take this sort of overreach, as I refer to it, in terms of these overbought periods and oversold periods into account when using Elliott Waves in terms of accuracy. A lot of people expect them to be a real accurate tool, and if anyone tells you they're accurate, it's nonsense. I'll leave it there. But what they can do, they can help you understand the possible natural waves that occur as a result of the imbalance between buyers and sellers. Generally, if the market's being really bought, you'll see price push up as there's an imbalance. There's not enough set of people selling, so to get the market to move up, you need higher prices. So you'll get that push upwards on the market and vice versa. They will provide you with potential targets for entries and exits in terms of they may give you some ideas of how to get into trades, and they may just back up some of the things you're already trading in terms of some of the patterns that you look for, the natural patterns you look for in the markets, and they can be combined with sort of current strategies very simply. I tend to do that more with them than actually try and just sit there and work out what they're really doing. What they won't do is predict the future accurately. There's always, as I say, this drive by, this extra push. I say always, but it's often a bit of an extra push one way or the other. So that you're not always going to get pure accuracy with it. And looking for nailing tops and bottoms, you might be lucky sometimes, but they're not. It's not really a timing tool. And to be fair, they're often they're most identifiable when they've already happened. So it's one of these things where you've really got to get your eye in, and we can look at markets, and you can look at markets on a daily basis and see, well, is that doing this or that? And you start getting a question, well, what may be looking like a bear flag may be actually the beginning of a bullish movement. So as I say, it takes some work. Now, what you must do is really use them only to enhance your trading and get the feel for the markets. And it's really where you're looking for that big picture trend. Are we in a market which is changing direction, or is it still heading in either upwards or downwards? It may just give you a sort of a picture to identify those early changes. What you must do is keep focused on what the trends and support and resistance levels are like. I always put them in reviewing first, because the market if you've got a horizontal resistance point, there's a good chance that the price would come up to that horizontal resistance point before it breaks. It may take a couple of attempts or more to break that horizontal point. So if you're expecting it to push up a lot further, it might just give you some patience, but watch out for those and expect price to stay there. If you can expect things, it helps you cope with it mentally. Now, if you look at the markets that you're trading, currencies have a different bias in terms of stocks. Stocks can have these sort of like super cycles. A particular stock may push up and up and up, whereas currencies tend to be more cyclical. We see as countries run through their different phases in the economic cycles, and interest rates rise and fall, you get these cycles in the markets. Different things happen. We get things like Brexit, and in the US, the elections, they can all move the markets and create uncertainty or certainty, and we'll see an effect on the charts. So be wary. Now let's have a look at the waves themselves. Firstly, let's look at the impulse waves. Now these are built up of 5 waves. The first wave, it's often less obvious, and this is why I said you sort of. I'm just going to draw here. Leading into this first wave, you could have been, I'm drawing a bullish impulse wave here. Leading into this, it's probably been driving down quite strongly. As this wave is forming, the market may still be largely, a lot of the news that you're seeing may be still negative. However, some of the bigger money that might already be trying to come into the market, they may see reasons for value, and particularly in stocks, if the stock's being seen as oversold, they might come in a bit earlier. And currencies, certainly, you'll get the movement often before the actual price action follows suit, or what the bigger price action might become follows suit. So here you've got this sort of move down, and effectively, as I said, you've got effectively this is a bear flag which is appearing, particularly when the second wave comes into play, which I'm going to just draw on quickly here. So when the second wave comes into play, well, that looks like that flag is actually working. So it often catches people, the first wave. Let's clear that up. Here we go, and push up. So that's often captures what we normally see on this first wave, or you can see, if you can watch volumes in any way, shape or form on currencies, you can obviously see it easily on stocks and indices, but commodities, if you can see the volume starting to rise as the price, it's a good sign of strength coming into the market. The next phase of this is this sort of retracement. This is the point, and particularly on the second wave, can be a point of disbelief. Now, often these sort of second waves, in a lot of the theory suggests about 50% retrace, but we see time and time again that the second wave pulls back quite deeply, particularly when you've been in a strong downward move. You think of it logically, the markets don't really want to give up this sort of downside. The bears are still thinking they're in control, and they are in control at that stage as it's running down there. However, what we might be seeing is the volumes, whilst this is happening, dropping off. It can be quite deep, but wave 2 cannot go lower than the beginning of wave 1. So it cannot drop lower, and vice versa if we were looking the other way up. So it cannot drop down. Wave 3, now this is really where people have acknowledged, okay, and particularly when you get a break of the top of the wave 1 there, when that breaks higher than that's a good sign in terms of what I'm looking for often is a break of that high there. It gives us a higher low if we talk about price in general terms. So it's giving us this higher low, and okay, it's at that stage, if the volumes are starting to pick up, we can see this quite big and strong wave particularly as more traders come into this market. So it pushes it, the volumes push up as it's running up there. We then move into the wave 4. Now this can be a bit of a messy one at times, because you've got into this impulse, this push, and there's sort of disbelief that it's going to roll over, and yet it's sort of teasing. And it can be teasing, and it can roll over, and you may have got the reading wrong, and you've got just a three-wave correction, and that's which we'll come on to in a moment, the ABC correction, and that's maybe all you've got in your move, and it could be rolling over here. So 4 should be watched carefully. It should not go lower than the high of the first wave there, so it shouldn't go lower. So it gives you an idea of where if you're trading the third wave, where you can move your stops up to at certain points if it's far enough. Because if it's starting breaking here, well, as I said, then it's maybe that fourth wave isn't the fourth wave, it's a continuation of the original bigger trend that was coming down, if there was a bigger trend. The fifth wave comes in. Now on commodities, this is the biggest wave often, not always, but it often is a bigger wave than the third wave. And this is where people get a little bit carried away. You run into these overbought signal mass. It's some traders will trade the fifth wave. They'll wait for the fifth wave to be trading. They'll see it as the safest wave. Again, you can look at this. You've got some targets. It will. I mean, I've drawn this quite simply. The fourth wave might, or the correction from the fourth wave may have been quite a bit deeper. So you've got at least to the previous highs as the initial target, and you know in theory it should be breaking the high of that. So that would be. Let me just draw on here. This gives you a better understanding of what I'm trying to say. So if it's deeper down here but not breaking this level, if it's deeper and then starts pushing up, and you can see the pattern that you're looking for here, you know, well, you've got to exceed this point in theory. So in terms of target wise, you know where you're going to be. You know it shouldn't be running below this area, so you can be putting stops if it's running below that area. So it's probably over, and as I said, it's more likely a corrective wave as opposed to an impulse wave. So there we are. There's the 5 waves. The fifth wave, as it comes up and it pushes towards its ending, you can see divergences in the market. You may be seeing a divergence between the top of the third wave and the fifth wave. There may be a divergence coming in there. Volumes may be dropping. There may be the signs that you would expect where something's topping over. Now, these can be either on the upside of a market or to the downside of the market. So you can flip it over the other way, or you can look at it this way on the upside. So it can, depending on the big cycle that the market's in. As I said, particularly on Forex, you might see it quite sort of controlled in terms of 5-wave move, 3-wave move, then possibly another 3-wave move, but then a 5-wave the opposite direction in the cycle. There is this sort of confusion that hits the markets when you run from one bigger trend into it's really reached the top then and it's moving over. Now the corrective waves, the first wave there then is, I'm looking from a market that's been pushing up. This is the area of disbelief in a sense for traders in their theory, in terms of they don't, well, or they're really confident at this point that the market's going to be pushing up further. Things may still look good, analysts look good. Okay, as we would be pushing up towards the top, you'll get a lot of the retail traders going the opposite way, and that in itself can see the market push up even higher on that fifth wave before it pushes through. And the important thing here with the A wave on the correction, really, well, sorry, I say the important thing with the B wave here is it can't exceed the top of, it shouldn't exceed the top of the A wave. So and I say it shouldn't. If it does, it may be part of the final kick-ins of the fifth wave. This is then followed by the C wave. Again, it's generally the larger, it's quite bigger. If the impulse waves have been particularly big, it might just be a little bit lighter, but it shouldn't be. That it should always be seen as the largest or second largest. It will not be the shortest of waves. Again, this corrective action can be correcting from a big impulse upwards, the correction to the downside, or vice versa. So you'll see either one of the markets, and this is what the basic pattern will look like. And you'll see these drawings in different forms in the markets. I've just literally loose drawn this, so it's just a shape I've drawn it in. A lot of these moves can be deeper, they can be longer in time, but it should look relatively clean. If it doesn't look particularly clean, my general advice is to walk away and leave it, or ask. We're here to ask. Now, each of these waves has a set of subwaves. So a wave up to a wave 1 may have 5 waves in it. A wave 2 may have 3 waves in it. A wave 3 again will have most likely and mostly have 5 smaller waves in it. A wave 4 again 3, sometimes 5 waves coming back here, and then 3 to 5 on that final shove there. But generally the 1, 3 and 5s, these impulse waves are stronger than the 2s and 4s, and the 5th wave is the questionable wave, because it's the market's running out of zip. But all the same, as I say, you've got waves within waves, so you've got these cycles, these sort of a grand super cycle, which could be running into centuries. That you've got the super cycle itself, which is more into decades. So you're looking at decades. You've got the cycle, simple cycle, that's really running into several years. You've got the primary levels, weeks and months, and as you've run through these, you're coming down to the intermediate, which is really into weeks itself. Minors, you're looking through to days, weeks. Certainly, minute is the daily basis, looking at dailies, and it's sort of just coming. There's a bit of overlap on these from what I picked up in my years of using them. You've got hours, you can run down into hourlies. Minute is probably sits here somewhere between a daily and a 4-hourly. The minute is really coming down to the multiple hours, and then you're coming down to minutes. So you've got these really tiny waves. They're just not worth playing with, because it's funny, we were talking about it recently in our day trading room, and you go down to a 5-minute chart and start looking for the waves. You'll see some of the waves really clearly, but you can lose a lot of money trying to play with the small waves. You're better off looking at the bigger time frames, running into the dailies and maybe the 4-hour periods. But you don't really want to be down to the hours and the minutes, or the single hours and the minutes. You want to be up there a little bit more in this zone where we can do more about them. So it's that sort of cross between day trading, swing trading, maybe even position trading. So this cycle, as they develop then, so these time cycles can be part of a bigger cycle. That's the important thing here. So you've got your 5 waves in your impulse wave. You've got your corrective wave maybe coming through is only a wave 2, and so on. So you've got your 3rd wave pushing up there, 5 again, another 5 wave move. How we identify them is really, if you just look at the price action, the basic price action, and you can identify them in terms of the move, the higher lows. So if you're looking through a market, just looking at the higher lows and the higher highs, and I'll refer to this when I'm doing my analysis of the markets. I'm looking for higher lows, higher highs on a bullish market, and lower highs and lower lows on a bearish market, and they are effectively the waves in the market. You can then maybe come down the time frame and see the movement within that. So if this is a 4-hourly chart, you come down to an hourly chart and you might see the waves a little bit clearer within those periods. So one thing I put here, you often get these channels or something similar to a channel. Certainly you should be able to draw a trend line. When the 5th wave is finished, then you're sort of working to see if it's going to have a bit more of a retrace. Now, as I said, with waves 1 to 5, I tend to count the bottoms or the tops as normal wave formation. You get 3 bottoms on on an impulse wave effectively, two of which are higher lows. That's a general pattern. If you get a whole series of higher lows, well, you may be in more than one wave. You're in a series of waves. You may be counting the third wave and the fifth wave, or the first wave, second wave, first, third, and fifth all together. It'll appear as multiple, can appear as multiple levels. I've sort of pointed out these sort of, there we go, there's the sort of three lows that you would get, or three lows which become higher lows. Two of them become higher lows as we run through here. But there are times on a fifth wave where it's moving so much you could get sort of the corrections as it pulls back and then pushes up, so you get that extra looking bottom in the whole move. So just be aware of that. Looking at the corrective waves, the corrective trend as it's referred to, here's some patterns that I've just sort of pinched this and popped it in, and it's really just patterns that you tend to get. And what you'll notice is you get these irregular patterns, and this is where it fools some people thinking the market's changing direction a bit earlier. They're thinking, well, that if this was a downward move, they're thinking, well, or a correction like a second wave in an impulse, they're pushing up, they're getting a bit early, and then it comes off, it frightens them out there. But you get these irregular waves. Really, I mean, on a real driving market, it might be very, very simple in terms of what happens. But what we see a lot of, and you can see the technical patterns here, the triangle, these double threes as they're referred to, and triple threes. It's where you get these lots of highs and lows, and it's just running in a channel. And so when you were seeing these channels form in the markets, well, they could potentially be part of a corrective pattern in an Elliott wave pattern. So the basic patterns, as I say, come through here. In the basic patterns, you get patterns themselves. And I'm going to keep this very simple. And when you're trading them, you could be looking at this sort of move here, and effectively this move here is a bit of a head and shoulders, and you're sort of seeing this head and shoulders coming through. So it's a very simple identifier. I daren't talk about them sometimes, but you can then measure the high to the neckline, apply that to the high to the downside, and start getting some potential targets of how it moves. You'll get at least equal throws. Often you get higher levels, 1.6, 1.8s and things like this, so you get much bigger. If I can put that on there, it'd be good. There we go, 1.6, 1.8s, etc. You get a bigger move, bigger correction. But you can see the sort of patterns they form. The most obvious pattern, of course, and I said this at the beginning, when you look at this, it's a flag. It's a little ball flag. So you could be looking again, extrapolate, look at the size of the flags, pop it on the bottom there, and you can extrapolate to where it might go. Now, one thing you know is, once you're in it, is that it's not going to be the smallest wave, so it's going to be at least bigger than 2, but most likely bigger than 1, so you can, or at least equal to, so you can again extrapolate what size that and apply it and look for targets in terms of where it might go. So all the time you're looking through other patterns in terms of, I've mentioned head and shoulders, cup and handle patterns where it sort of price comes down. If I do the rest of this market here, so I made it look like a V bottom, but you've got this price action here, so you've got really, and it might have a curved bottom as it comes around there, and there's your cup and handle pattern. And again, you can extrapolate and look at the lows there and pop them across the top there, and it gives you targets. So there's many different ways. There's other patterns such as Gartley patterns, which can be shaping up, where basically a Gartley pattern pulls back 1, 2 like this, and then pushes up and then rolls over. It doesn't exceed the high. I should just draw that a little bit higher. It doesn't exceed the high here. Now this is probably this here. That's the Gartley pattern. So you've got your wave down. Now your wave down could be 5 little waves sitting in there. It could be 3 waves down there, but it could be most likely be 5 waves, a bigger move. Depending on how quick the market's reacting, and then you get this sort of 3-wave push in here, and it's a Gartley pattern, and then it fails at a retrace relative to that. If I put an X there, X, A, B, C, D, it fails on the bottom there. So there's other patterns. Butterflies come in. Butterflies are more likely to be this side of the market, because on a butterfly you've got the similar pattern, but the high goes, the move goes higher. So that could be somewhere between a 4 and a 5. So you've got this retracement here. It's coming back into the retracement, pulls down, carries on for a little bit more of a retracement to the downside, but the market's still quite strong, and it pushes through and gives us the end of the overall move. That actually becomes the fifth wave, and again, that's a butterfly, is referred to in the markets. I'm getting technical here, but they're the basic patterns that are sitting through on a real basic pattern. Let's clear that off. So I've listed some of these: head and shoulders, cups and handles, Gartleys, butterflies. So there you go. Okay, some takeaways from you. Just bear in mind, it's not totally accurate. You'll get overruns. You'll get pushed beyond where you think if you're using Fibonacci with it, which I'll be talking about in a second. But if you're looking at anything like that, you can get price action. You can be wrong. It takes an eye to get into it and use it a lot. They should be seen as a guide. They are, in effect, just another way of reading price action, but a good way of understanding the price action in terms of you see and getting the brain used to the way the market moves. You get the impulse waves, the stronger waves, and then you get these corrective waves. And when you see a corrective wave, and if you're in a more of a swing position, you can accept, depending on the time frame you are, well, that's just literally a corrective wave. I can expect that, and there's a reasonable chance that this is the third wave. It's going to carry on and do the fourth and fifth. So it may be the fourth wave that's running out, and you're trading the fifth wave. But it helps you work your psychology out of trading a little. I've added an extra little bit on here. The third wave, or the number 3 or C, are normally the biggest, so that gives us an opportunity to be looking at these. And put wave 5 also exceeds the high of level 3, so if it's retraced after level 3 by a way, well, we know that top of the wave is a target at least to be broken. So it helps us identify targets. Now you can add, as I'm already alluded to, you can add Fibonacci for a little bit more confluence. So there you are. It's run into nearly 30 minutes, but it's a really big subject. I could spend a day teaching it and looking at all the different parts, putting Fibonacci in there and giving you percentages. And maybe I'll do another video and just add some more detail at a later stage. Now, if you like this video, please put a thumbs up, like it. If you've got questions, fire the questions away and I'll reply to them. And that is it. That is the introduction to Fibonacci and how to use them. Did I say Fibonacci? I actually meant that is the introduction to Elliott Waves and how to use it. It's nothing at all to do with Fibonacci, or not much. There we go.